Good day, this is the third and the last part of our discussion in financial decisions. In the previous videos, we discussed the financing decisions and the investing decisions. Under the financing decisions, we discussed the capital structure. And under the investing decisions, we discussed the capital budgeting techniques and the working capital management. In this video, we'll focus on the dividend decisions. But before we discuss the dividend decisions, let's first discuss what dividend is. The dividend is a distribution of the profits to the business's shareholders. So how do we get these shareholders? When we had the discussion in financing, we had a debt or an equity financing. Whenever we choose an equity financing, we give out shares of our company to different individuals. These individuals become your shareholders, and therefore we are obligated, the company, the business is obligated to distribute its profits to these shareholders. A dividend could be given out in several types. We have a cash dividend, a stock dividend, a bond dividend, and a property dividend. Cash dividend basically is just plain money from the business to the shareholders. Stock dividend, so instead of giving out money, the business decides to increase their shareholders' stocks, meaning they would award more stocks to the business's shareholders. They will assign a percentage of how much stock dividend they will issue. They could issue this in like 10%, 20%, 50%, depending on the declaration. For example, if a company decides a 10% stock dividend to its shareholders, their shareholders will receive an additional 10% of what they have in their dividend. So if I'm a shareholder in that company and my shares is 250 and they will issue a 10% stock dividend, therefore they will increase my dividends by 25 more stocks. So I would have 275 since 25 is the 10% of 250. Next, we have the bond dividend. The bond dividend is also known as the scrip dividend. This is more of a promise to shareholders that the company will issue a dividend. And in line with this, the company will issue a note that specifies when the dividend will be paid, will be given to the shareholders. Lastly, we have property dividends. These are dividends that are paid with physical assets. So these are assets that are other than cash. We could have real estate, we could have inventories, raw materials. So anything that is easily liquidated by the business could fall under property dividends. So let's move on with the dividend decisions. The dividend decision, also known as the dividend policy, is concerned with the amount of profits that are to be distributed among the business's shareholders. It decides how much of the profit will be distributed to the shareholders, how much will be retained for the business to use on their future endeavors. Because of the factor of the retained earnings, it actually makes dividend decisions partly influenced by financing decisions, since financing decisions are made up of what we call an internal finance, and dividend decisions uses retained earnings, which is part of that. The decision of how much dividend to distribute to the shareholders depends on the dividend policy. And we have several types. We have stable, constant, progressive, residual, and hybrid. In the stable dividend policies, the company strives to give dividends every year, every financial period without fail. And this is regardless of how the company is doing. So whether or not there is a financial gain or a financial loss, whether we are at a break even, the company will give dividends out to its shareholders, because that is what the stable dividend policy implies. Now, if they're experiencing a loss or a break even, why did they choose a stable dividend policy? This is most likely because of what we call the long-term progression. It is the estimation of the returns made by their investment ventures. The problem with stable dividend policies is that they forget that the estimation are basically assumptions, and nothing could ever perfectly assume how much returns which we will get. Next, we have the constant or the regular dividends, and this is the opposite of your stable dividends. In this kind of dividend policy, the dividend payouts fluctuates every financial period depending on the financial gain or the financial loss of the company. They are linked to short-term financial decisions since they deal with the current financial standing of the company. This means that the financial managers and the board of directors will need to set a specific percentage of their earnings to be given out. The stable dividends may feel more attractive since it gives out a stable every year the same amount, but it's not actually safer. The constant dividends is actually a more conservative way because it preserves its profits for the possibility of risk and for future purposes. Therefore, it could be the constant dividend policies may be a bit volatile, but they're only making sure that the business would run smoothly for as long as it can. Next, we have the progressive dividend policies. This is a variation of the stable dividend. The only difference is that each year the dividend payout in the progressive dividend policies gets higher, and this is again regardless of the financial gain or the financial loss of the company. Number 4, we have the residual dividend policy. Residual dividend policy puts their profitability first. So how does this happen? They allocate a portion of their returned earnings to their probable investment ventures. Whatever is left from that retained earnings, they distribute it for dividends and not the other way around. Last, we have the hybrid dividend policy. This is just a combination of the stable and residual policies. Now we discuss the factors affecting the dividend decisions. We have 5. We have the profitable position, the uncertainty of future income, the liquidity position, the sources of finance, and the growth rate. First is the profitable position. If the business earns more profit, then the business can give out more dividends to their shareholders. If we don't have profits, therefore we cannot give dividends. And if in stable or progressive dividend policies, we still chose to give our shareholders a dividend payout, regardless of whether we are at the break-even point or if we are at a financial loss, we risk eating up our working capital. And you know what happens when the working capital is diminished? We go into financial risk and we go into financial loss. Number 2, we have the uncertainty of future income. This is the decision of whether we'll select a stable or a constant dividend policy. Since future income is going to be very hard to predict, it will be very beneficial for the business and its shareholders that we use the constant dividend policy. Why is it perceived as better for the company, or also better for its shareholders' sake, even for the shareholders' sake? Now, the idea of the constant dividends is that it is linked on the short-term progression. So the dividend fluctuates every year. There may even be times when there is no dividend to give. There would have no dividend payout. Now, how is that exactly positive? This action implies that the business is trying to sustain itself. Therefore, they reserve their profits for the long-term business goals, and they preserve their retained earnings so that the business can run for as long as it can, for as long as possible. And if the business runs for a very long time, that means we could have more profits, and more profits would mean more dividends. Number 3 is the liquidity position. If the company has cash to give out, then we would have no problem with giving out dividends at all. If the cash is already there, then it is easy to dispense. The more liquidity the business has, the more easy it is to organize dividend payouts because we have money to give. Number 4 is sources of finance. Typically, dividends are taken from the internal finance, and this is the retained earnings part of the internal finance. If, however, another form of financing becomes available, that frees up the retained earnings for probable future investments. Lastly, we have the growth rate. The growth rate is the company's increase in revenue. So a higher growth rate would indicate a better capacity to pay out dividends because that means they have more profit. Last, we discussed the theories of valuation of the dividends. These theories dictates how much a dividend gives to the business and not how much value it gives to the shareholders. So this is the dividend and the firm that we're talking of, the dividend and the business. In the dividend relevance, this theory implies that the dividend decisions affect the value of the firm because of the attraction it will give to the possible investors. More investors equals more money, and more money is equals to more value in the firm. The proprietors of this is Professor James Walter and Myron Gordon. The second one is the dividend irrelevance theory. This states that the business does not benefit from the dividend decisions. It implies that it hurts the business because instead of investing the retained earnings into possible business ventures, it distributes them to the shareholders. The proprietors for this is Professors Modigliani, Solomon, and Miller.